Okay, Bank of Canada buys $50 million in bonds from the general public. What's the change in reserves? What is the change in reserves? Visualize it. Here's me, the Bank of Canada. I'm going to buy $50 million worth of bonds from America. What's the change in reserves? What's the change in reserves? Eric? 50 million. It's like the Bank of Canada is Midas. What it touches turns to gold. If I buy from America, she gets 50 million from me, the Bank of Canada, right? Now the Bank of Canada doesn't take money that it already has sort of saved up. Somebody deposited there. They just make their own money happen. So it enters the system, right? Okay, good. What's the change in reserves? So our change in reserves is plus 50 million, and change in money supply is plus what? Yeah, Omar.
50 million?
50 million? The change in money supply is the change in currency in circulation plus the change in deposits. What is the change in deposits, Omar? Deposits are what formula? What's the change in deposits? Alexandra. You're looking sharp, but maybe not.
625.
650?
625.
Okay. How'd you get that?
50 divided, oh sorry, yeah, 8%.
Yeah.
So 50 divided by 0.125 is 400.
Okay, everybody? Plus 400 in equilibrium. Okay, now you've got to be thinking. What is the change in reserves and money supply if the Bank of Nova Scotia buys 10 million in bonds from the Bank of Montreal? What's the change in reserves? Here's my clue. Follow the money. Always follow the money. There's only one magical person in this game. Go ahead, yeah. What's your name again, sorry?
Andre.
Andre. Yeah, Andre, go ahead. What is it?
Is it 0?
It is 0. Why is that, Andre? Alicia, why? Tell us.
Sorry, because they're buying for they're buying for banks, like other charter banks.
Exactly. So all that's happening is, in this case, supposing Omer and I'm just blanking. Farnaz, yes, Farnaz are the banks. Omer buys $10 million worth of bonds from Farnaz. Farnaz pays and loses reserves of 10 million. But Omer gets reserves of 10 million. There's no change in the reserves of the banking system because the banks can't change their own reserves, right? So normally in these questions, always look for the Bank of Canada for a little key. Then here's another one. What is the change in reserves and change in money supply if federal government increases taxes by 800 million to pay 600 million for Pan Am game construction and deposits 100 million in the bank, the TD bank, 50 million in the Royal Bank, and 60 million in the Royal Bank, and 40 million in the Bank of Canada. What is the change in reserves? Okay, what's the change in reserves? What do you say, Kyle?
Is that a trick question because you did?
It's not a trick question. It's flat out, follow the money. What is the change in reserves?
Don't you do the multiplier?
We've got our reserve ratio, which is 12.5%. You used it, by the way.
No, but I mean, when the government spends 800.
No, we don't have to worry about that right now. No, because we're talking money moving around, right? It begins with, like, just follow the money. The government of Canada increases taxes by $800 million. You guys take that money. Where do you get your $800 million when you're paying your taxes? Where would you get that from? What? From your bank account. So perhaps if you want to do it in the concept of cash, you take $800 million out of the bank and you give it to the federal government, right? And then the federal government spends $600 million on construction. Where does that end up? Back in the banks, right? It ends up in the public, but then it ends up back in the banks. This is like evaporation, rain, no change in the level of the water table, right? So $800 million came out of the banks in cash, $600 million was spent on construction, it ended up back in the banks as a deposit. The bank specifically deposited $100 million in the Bank of Nova Scotia and specifically deposited $60 million in the bank, Royal Bank, and so all that went back into the banking system. So far, all we have is a circle, out and back in, except for what? 40 million disappeared through the Bank of Canada. Reserves fall by 40 billion. Everybody? Reserves fall by 40 billion, and deposits go up by 320 billion. Okay, everybody? Notice it? Bank of Canada. Make sure you can do this. You're going to see lots of examples in my notes and in my problem sets. Okay, next. This one you're going to make a mistake on. So try to wake up. Okay? What is the change in reserves and money supply if the public takes out increases, I should say, increases money supply by 50 million to avoid taxes. So it can deal in terms of cash, so it can avoid tax. What is the change in reserves? You, the public, are now holding 50 million more in currency in circulation. What is the change in reserves? Okay, come on. If you guys need cash, where are you going to get it from? Huh? The bank. So therefore, it implies reserves must go down by 50 million. You can't take it from the Bank of Canada. They will touch you. So if the currency in circulation goes up by 50 million, reserves go down by 50 million. Okay? You should be able to get that. Now this one you probably mess up. Don't. What is the change in money supply? Oh, no, reserves fall by 50 million. What's the change in money supply? Well, what's the change in deposits if reserves fall by 50 million? Change in money supply equals minus 50 divided by 0.08 by 1.25 by 0.1.25, which is equal to, I think we've had this already, minus 400 billion. Is that the answer, by the way? Is that the correct answer? You're going to get a correct mark in this in an exam? Who said no? Well, is it or isn't it? Erica, fill them in.
Isn't it the minus, that's the change in?
Yeah, again, when I ask you to change in money supply, you always go check. What's the change in currency in circulation? Well, in other examples, there was no change in currency in circulation, so we simply changed deposits. Here, we changed currency in circulation to start the whole ball rolling. So it turns out to actually be plus 50 minus, so it turns out to be a total of minus 250. And I'll be asking that question on the exam. All right, everybody? This is the basic money supply stuff. I need you to be able to do the problem, this kind of problem set. It's not difficult. And of course, those stuff I'm going to ask you, do you understand what we're talking about? But that's only 2 or 3 marks somewhere down the line. Okay, for usage in this. It is actually pretty fascinating. And so flat out, if the Bank of Canada announced that they're not changing interest rates. If the Bank of Canada wants to raise the interest rate in Canada, i.e., we say they have to decrease the money supply. And how would they do that, people? They would sell bonds, or they would switch government deposits from the private sector to the Bank of Canada. And they must do this physically. That's what they must do, and then the money supply will change, and we get the next step. Okay? So, here's the next step. So far, we have on this axis the interest rate. It's called the real interest rate. It's corrected for inflation. And over here is real money supply, which we express like this, divided by P. Again, it's the money supply corrected for the price level, right? Like we do it normally. Now R, the real money supply is defined as nominal, or the real interest rate is the nominal interest rate minus the rate of inflation. The idea being, supposing I said to you, look, the interest rate is 5%. Would you please lend me $10,000? Like you want to buy a car for $10,000. You want to buy a car for $30,000. And I said, put it off for a year. I need the money. The interest rate is 5%. Lend it to me at 5%. And you go, okay, I'll have like $31,500. I'll make like $1,500 a year. Interest, okay, this is okay. I don't really need to get the car. But what if inflation is 5%? What if it is? Then at the end of the year, when I pay you $31,500 and you go to buy a car, thinking you've got an extra $1,500, lo and behold, the car is $31,500, right? So it turns out you never made anything in real terms. So basically your real interest rate is 0. And it turns out, so we say, that turns out, the interest rate today is virtually nothing, right? But inflation is virtually nothing. So the interest rate is basically maybe 1% in real terms. The nominal interest rate in 1979 was 16%. Wow. But the argument is, inflation was 14%. Therefore, actually, the real interest rate was only 2%. It doesn't fluctuate that much, right? Everybody? So, this is not an idea you hugely need to know. It's not going to be a question on the exam that I know. But we use the real interest rate. Again, a little something like this to fill you in. U.S. interest rates. Wait. Okay, Bank of Canada rates very similar. There's the U.S. interest rate. See it? Now let me see if I've got one here comparing it. Okay, I need this thing. Price cycles. All right, let's look at this. Hey, they're almost the same graph. Notice? Look. Rises like this, up here, down, up, down, very high here. There it is. Interest rates are high because inflation is high. Interest rates are low because inflation is low. Now, real interest rate will fluctuate, but not like that, maybe between 1 and 4%. But the nominal interest rate might fluctuate between virtually 0 and 20%. Okay? So we talk about the real interest rate. Now, we say that the real interest rate, if we're going to go back here, I'm cutting a little bit to the chase here, so we get right to it. We're now plotting the money supply, like this. This is the money supply in the economy. And you know what it is. If we want to change it, we just got to have the Bank of Canada do something. Everybody, it's that simple. So, there's the money supply. Now, it turns out, and again, this is, I'm going to just show you my notes. The demand for money. This is a big issue, the demand for money. Theoretically. Right here. Okay. The money demand. Now I'm going to explain this through what's called present value, but I'm not going to worry about too much about it today. You guys can read it. The other classes won't do it. And I'm going to go through this. See this thing here? This is called present value stuff. But I'll explain to you this kind of stuff. You don't need to know this. All the present value stuff you don't need to know, but please look at it. Here is what the classical economists, the pre-Keynesian economists thought. Let's just think about their argument. Would anybody want to hold money? What is the reason to hold money? And they said, the only reason that a person would want to hold money is for transactions, to buy stuff. So I would say, okay, here's $10,000 for you, $10,000 in cash. How much of you would you hold in money, in cash? And basically, the answer would be, I would hold no more than I needed to buy things with. I would never want to be holding money because in a sense it's useless. It gives you no interest, it gives you no satisfaction. You use the money, maybe you go on a holiday, blah, blah. The money that you didn't want to spend, you would save, granted, but you wouldn't save it with cash. Why not? Because you could put it in the bank and get 2%. You could buy a bond and get 3%. So we say the opportunity cost of money is the interest rate, right? So nobody, if you think about it, if your grandmother gave you $10,000, you'd really be an idiot to keep it in your house. You would put it in the bank and get interest, right? That would be the obvious thing. And the classical position is, would anybody want to hold, like, you know, $100 million in money, like just sitting there, virtually having no interest, and, you know, like as a deposit with no interest or cash? And the answer would be no. Nobody would ever want to hold $100 million. They would spend it on something or buy an asset. They would invest, right? They would buy an asset. And for you to get that kind of money, you'd have enough sense to do that. So the classical view is this, and this is what we call the quantitative theory of money. Number one, money is solely for transactions. Everybody who gets money spends it, either on commodities or on bonds. So money is immediately spent. Number two, the classical view, what is the classical view of full employment, people? What is it? Always at full employment. So therefore, if everybody's spending this money, if you give more money to people and they spend it, what happens to the economy? Huh? It can't expand. We're at full employment. It can't expand. When you're at full employment, how do you expand? It's basically, in terms of you can, but essentially you can't, right? For any period of time, you can't. You're at full employment. You're working flat out. You can't. There's no more goods to be produced. A trick I learned when I was a kind of contractor, younger, I was like fixing up houses and stuff. And the key element is you want to get busy. Like I had, there's a crew and everything. And we would, once you always have some slack. And so when you didn't have everybody working and someone said, how much does it take to make fill my kitchen? You had to think competitively. So you think, I need this job. I'd like to get 20,000, but I'm going to charge them 10 because I can't risk not getting the job, right? Okay, good. Now, supposing we're working on somebody's kitchen. We're totally booked for 3 months or whatever it is. And then someone comes along and says, how much to do my kitchen? I go, actually, I can't do any more kitchens. But I could somehow not do this kitchen right here, which is only paying 10,000. I could drag my butt on that, which you see in many construction projects. So I just say to the person, $30,000. Okay, hey, this is good. I don't care, right? I can't do anymore. If you want me to do it, $30,000. Okay, fine. Yes, then we do it. We sort of slack off in this kitchen and we do that. Somebody else wants it done, right? So once you're at full employment, all that happens is prices go up. There's no more kitchens, there's just prices going up, right? First rule. So basically, the classical view is transactions demand, everybody spends their money. This doesn't change output because it's already full employment. Prices go up. No effect on output. Okay? It's called the neutrality of money or money dichotomy. Okay, and so we model that. I explained to you the evolution of that a bit. It's kind of interesting, but if we didn't work, if it wasn't the summer, I explained you the Fisher equation, the Fisher identity, look at it. But we're going to use this idea. This is the one that Marshall used, this. The transactions demand could be expressed like this. Money demanded is a function, some proportion of your total income. So in particular, supposing K, it'll be a parameter, for people is 0.15. And GDP, nominal income is, let's say, 100, then people can hold 15 billion of their income in money. That's the only money they need, right? And if you think about it, your income, how much do you make in a year? Say it's 20,000. You don't hold it all in the form of money. At any given time, there's only like so much in the bank account, right? Everybody? So the amount of money that's held is a proportion of total income, transactions demand. If your income goes up, you need more money because you're buying more stuff, right? But other than that, that's the only reason that you need more money. That's the demand. Then Keynes pointed out this incredibly obvious thing, which is astounding. And the Bank of England has been doing this for years. And banks always did this. Sometimes it's amazing in economics. The theory marches along, and everybody in business knows it's totally drivel. But Keynes pointed out, I'm going to ask you guys a question. It turns out, by the way, that if your grandmother gave you $10,000, you wouldn't hold it in cash. You might buy shares in Apple Corporation, let us say, right? You do that. Or you'd buy a bond that gives you 5%. Now my question is this, is there a time when if your grandmother gave you $10,000, you wouldn't buy anything? Is there ever such a case? Because that was denied by the neoclassical economists. But Keynes said, oh, by the way, and Keynes was a fabulous speculator, made huge amounts of money. When do you hold money instead of buying Apple stock or a bond? When do you hold money instead of buying Apple stock? Tell me, people. When? You know the answer. Go ahead, Cash. Huh?
During the recession.
Why in recession?
Because prices are, or
And specifically, what kind of prices are going down?
the stock prices.
That's right. If you know that the Apple stock is going up in price, yeah, you buy Apple stock. But if you know it's going down, you don't buy it, right? You don't buy it because then you lose money. If you buy $10,000 of Apple stock and then you have to sell it at $9,000, sorry, you lost $1,000. That's obvious. So Keynes says, he calls this the speculative demand for money. But there's a time when the best thing to hold is money. Now it turns out, by the way, 6 weeks ago, 4 weeks ago to 6 weeks ago, it turned out a time when the absolutely best thing to hold was money. Nothing but money. Not bonds, not stocks, because what happened was this. Bernanke, who was the chair of the Federal Reserve Board, which has been, as you saw, flooding the market with money, like cheap reserves for the last 4 years, announced tentatively, this was about 5 weeks ago, announced this. We think the economy is getting better, and when we think it's ready to grow on its own, we're going to stop pumping, buying every week, every month, I think every week, every month, they buy $85 billion of bonds, the Federal Reserve Board. We're going to stop doing that. We're going to stop flooding the market with reserves, i.e., it's called quantitative easing. He just said it was going to happen in the future at some time. Everybody knew this is going to happen sooner or later, and it's going to happen when the economy gets better. Because you don't have to do this when the economy is growing on its own. So what happened was the marketplace reacted badly. They figured that if he was going to do that, you know, that basically bond prices were going to go up, actually down, interest rates were going to go up, stock prices were going to go down, and the stock market and the bond market fell by 4% in 2 weeks. So you think about it. If you guys had $1 million on June, something like June 10th, June 15th of this year, on June 30th, you had 40,000 less. Now, that would be your whole earnings for the year. Like people would be saving, if you could make 4% in a year on $1 million, that would be good under these conditions. And you just lost it in 2 weeks. So in short, if you had sold and gone liquid, you would still have your $1 million in cash, and you could buy back in all your stuff you already had for $960,000, right? In short, the thing to hold was cash. And that's what Keynes pointed out, right? So the time to hold money is when the price of stocks and bonds goes down. Now, the thing is this, the nearest equivalent of money is a bond. And you would think, a bond price doesn't go down. I buy a bond. It's not like a stock. It doesn't go up and down, but actually it does, right? It turns out if interest rates go up, bond prices go down. Okay, let's just think about this. I explained this in my notes very carefully. You must read it, but given pressures of time and the fact that this is not, I just want you to understand the concept and we'll move on. Here's the deal. What a bond is this. It pays you a fixed amount. So the government issues a bond today, it's like a $10,000 bond. You can buy it. And the bond, let's say the interest rate today is 10%. Or 5, I call it 5%. And I'll say 10% for easy sake. Which means at the end of the year, to make it simple, if you buy the bond, at the end of the year, 1 year later, you get a 10% payment. But actually you don't. What you get is, this is a $10,000 bond. You get $1,000 on December 31st this year, and $1,000 on December 31st next year. It's a 10-year bond. It's going to give you $1,000 at the end of every year for 10 years, and then you get the $10,000 back. This is a bond, right? And then you look at that and you go, the bond is paying 10%. Everybody? The bond is, I buy the bond for $10,000. The interest rate is 10%. The bond pays me $1,000. I'm getting an interest rate of 10%. Everybody? Okay, now. But the bond doesn't guarantee the interest rate. The bond guarantees the payment. So supposing next year, the bond, the interest rate falls from 10% to 5%. Let's just say that, okay? And you go to sell your bond. It's a stupid old bond. It's not like a stock that goes up and down. It's a bond. How much do you think people will pay for your bond next year if the interest rate is 5%? Well, think about it. How much to get, you're not selling that thing that's worth $10,000. You're selling an asset that pays $1,000 a year. And what does it take if the interest rate is 5%? How much would you have to lend out? How much money would you have to lend out to get $1,000 a year at 5%? Think about it. How much would that be? If you paid $10,000, would you be able to get $1,000 as an interest? If the interest rate is 5%? No, what would you get? $500. So how much would you have to pay for the right to get $1,000 a year? $20,000. Now, of course, this is kind of a, we have to do a few adjustments for the fact that you get $10,000 at the end of so many years and so on. But basically, that bond will sell for close to $20,000. And you didn't do anything. You just bought a safe little bond. All you cared about was $1,000 a year, and for some reason you had to sell it because you had to pay your tuition. And wow, you get $20,000. This is unreal, right? But here's the bad news. What if the interest rate goes to 20%? Then you go to sell your bond, and no one will pay you more than $5,000 because for $5,000, they get $1,000 as the going rate. $1,000 is the return of $5,000. You wouldn't be able to sell your bond for more than $5,000. So notice everybody, if the interest rate goes up, we say the present value of your bond goes down. If the approximate value of an asset is the return on the asset divided by the interest rate. In this case, it is $1,000 divided by the interest rate, 0.05, 0.1, 0.2. Everybody?